Hello, and thanks for joining us. I'm Matt Booton, an independent financial planner at Hello Financial Services. We're proud to work with and offer the services of some of the very best industry names in terms of investment managers, funds, and providers for the benefits of our clients. Where possible, we also like to give a platform to some of the industry specialists and communicate directly with our followers and clients. Massimo Vani is our dedicated investment analyst at Hello, and he spends much of his time analysing investment solutions independently available to our clients. Where our clients require, we seek to incorporate some of the best-in-class responsible solutions within our client portfolios. Today, we're especially pleased to welcome Mike Fox, Head of Sustainable Investments at Royal London Asset Management, as our guest. Mike is also Fund Manager of the Royal London Sustainable World Trust. Hi Mike, welcome and thank you for joining us. Can you please give our viewers a quick overview of the Trust in terms of its investment strategy and how it's positioned for the current market cycle?
So the Sustainable World Trust is, as it's described, a sustainable fund, which is effectively saying that the world is going to change quite markedly in the next 10, 20 years, which is a reasonable time horizon for most investors. Simply put, it'll become more digital, decarbonised. It will also become a lot healthier, and that in that context that we think there are some investment opportunities that look very good and some investment opportunities that look very bad. So simply put, we would rather buy the company that's taking carbon out of the energy mix rather than the company that's putting into it. We'd rather buy the company that's curing lung cancer than the company that's causing it. So the simple principle of sustainable investing is, be part of the solution, don't be part of the problem. I think how it fits in with current market cycles. We are in a period of rapid economic recovery at the moment where more commodity orientated businesses and businesses, to be frank, that we just think are less sustainable and less relevant on a long-term view are doing much better. So, we've had a really good decade and we'd expect the next decade to be pretty good too. But the last 3 or 4 months into the cyclical recovery just been a little bit more difficult just because of the way we invest.
Excellent, thank you. As part of the overall approach to responsible investing, how would you define and measure sustainability in the management of the Trust? Can you please give any specific examples in terms of stock selection?
So I think measurement of sustainability is a great question. There's no doubt that a huge amount of what we do is qualitative, and unashamedly so. Taking a view on whether social media is socially positive or not. For us, it isn't, versus knowledge search, which we think is, inherently is subjective, and people in our team have different views. Also, the ability to numericize that is difficult. How can you numericize the benefits of knowledge search? I think we all probably know they're pretty big, but how you put a number on that is unclear. So I think, how you measure sustainability, I think will be inevitably a mixture of numbers and words. I think what you can do numerically is a lot around carbon footprinting, environmental impact. Those numbers tend to be pretty objective and available. So, we carbon footprint this fund, we show it versus warming potential scenarios and other such characteristics. And, the fund looks good on that. It's certainly very low carbon. But then equally, when we get into some of the more social aspects, we have to acknowledge that it isn't necessarily always possible to numericize that. And then we need to provide good commentary around what we do. So, a lot of the work we do is involved in, employee issues, supply chain issues, culture of businesses and so on. And that we will report as narrative because it is very hard to quantitate. So the rise of ESG data is a thing, and no doubt over time we'll be able to do more numerically. But at the moment, and probably in the future, it will always be a mix of quant and qual.
Are you confident that clients invested in the Trust would be shielded from the risk of greenwashing?
Yeah, look, greenwashing is, you say potato, I say potato type issue. I think greenwashing is meant as a general term to say that funds don't match up to what they say they do. Now, but what funds say they do can be very varied. So if you look in the sustainable space, you have a spectrum of funds, from very narrow environmental funds to people like us who are more pragmatists, to be honest with you. We kind of more take the world as it is and try and improve it. And we do that because we think we'll get a better financial return out of doing that. And we think because it appeals to more people, that at the end of the day, we're all part of society and we all do things that, maybe we could do a little bit better. So, one person's greenwashing is another person's pragmatism. So, I think the critical point though is do we do what we say we do, which is basically pay a lot of time looking at ESG standards in businesses, looking at products and services of the companies we invest in, and understanding overall, do they have a benefit to broader society? So that we will always get queries about some companies we own. It's inevitable because, like I say, people have different views about what a sustainable fund should be. But, this is a process that's been in place for many, many years. It's auditable, it's overseen by an external advisory committee. So what we always say is, you might not always agree with us in terms of ultimate decision, but hopefully you'll see that it is a proper investment process, properly overseen and done in a way that means that, you should take confidence in that.
Thank you.
Mike, can you please provide one or two examples of stock selection underpinning your investment process, please?
So I think a couple of good examples that are relevant at the moment. One of the largest holdings in the fund is Philips, which people may know from their kind of consumer electronics franchise, but they are also a provider of ventilators to the healthcare system and also critical care infrastructure. So they have some very interesting equipment and software that allows critical care wards to be managed more efficiently, more effectively, and so on. And as you can imagine, they've had a very, very big role to play in the pandemic. We also invest in AstraZeneca, which is a company that is of a lot of interest and talk at the moment, but they are involved in a huge humanitarian exercise to try and provide a vaccine at cost at low prices to developing countries that ultimately will rid us of COVID over time. So they'd be great examples in healthcare. Equally in energy, we invest in SSE, the UK's largest renewable energy developer, which we think has a critical role to play in decarbonising energy in the UK. So I think, like I've said before, if you look really at how the world is going to be in 10, 20 years time, less carbon intensive, more health aware, more digitized, we really try and play those ideas and manifest those in the stocks that we own.
Thank you.
Sometimes there's a perception in the public at large that funds incorporating environmental, social and governance considerations in their investment decisions might potentially deliver inferior investment returns compared to funds which are not so constrained in their choice of investment. Do you think this is a misperception, and how do you ensure the trust can deliver consistent, sustainable returns over the medium to long term?
Yeah, I think it is a bit of a myth. I mean, one thing that is interesting about the industry I work in is how transparent it is. So every day, this fund is priced, so you can see whether it's done better or worse than its peer group. Every week, every month, every year, every decade, it is. So in some respects, we work in the most transparent industry there is. So there should be no ambiguity about whether sustainability enhances or detracts from returns. And the evidence based purely on the performance is pretty compelling that it enhances returns. And why wouldn't it? I mean, why would an environmentally poor, socially irresponsible, badly governed company be a good investment? It won't be. And, really, to the extent of what we do, it's just premised on that very bit of simple common sense. And maybe 20 years ago, when I was growing up, watch Erin Brockovich and Dark Waters and all these other kinds of films, corporates did bad things. It didn't seem to really resonate, but the penalties for corporate misbehavior are much, much higher now, and the rewards for providing solutions to issues are much higher. So I think observably through performance numbers and then intuitively in common sense, there should be a very strong case for sustainable funds doing better over time.
Thanks, Mike, for your time and for comprehensive answers to our questions. It's really much appreciated. Thanks to everyone for watching as well. I hope you enjoyed the content and found it useful and informative. For more information around responsible investing at KLO Financial Services, please feel free to contact us. We'd really be delighted to hear from you.